Imagine you're evaluating a massive multinational corporation for, a major portfolio inclusion.
Right, a really high-stakes decision.
Exactly. You are tasked with determining if this company has sound governance, ethical leadership, and long-term viability.
All the fundamentals.
Yeah, all the fundamentals. But there is a substantial catch here. All of the actual financial maneuvering, I mean, the real reasons behind their corporate structuring, they are completely locked inside a legal black box.
Which is incredibly common, unfortunately.
It is. You don't get to see the internal memos, you don't get to trace the wire transfers, and you definitely have zero access to the unredacted financial logic.
You're just flying blind on the details.
Completely blind. The only hard data point the regulatory filings actually hand you is a geographical map.
Literally just dots on a map.
Right, just a map dotted with pins showing the specific jurisdictions of the company's offshore subsidiaries. And from those pins alone, you have to decide whether this company is engaging in standard global business or something far more illicit.
It seems like an incredibly thin premise for making multi-billion-dollar investment decisions, honestly.
It really does.
Yet that dynamic is playing out across the global financial market every single day. I mean, analysts, executives, institutional investors, they are constantly judging corporate intent based almost entirely on geographic footprint.
It's wild to think about.
It is, because when the financial facts are deliberately hidden through offshore secrecy, well, geography just becomes the ultimate proxy for corporate character.
And that dynamic is the exact mission of today's deep dive. We are exploring a fascinating 2026 academic paper from the Journal of International Business Studies.
Yeah, a really groundbreaking piece of research.
It's titled In a Bad Place: Location and the Relationship Between Tax Haven Use and Corporate Reputation. We are going to look under the hood of how the world's biggest companies are judged in the highly critical arena of elite public opinion.
Because the stakes there are just massive.
Massive. Specifically, we're trying to understand the divergence in market reaction. Like, why do some corporations face severe reputational penalties and investor backlash for using tax havens, while, other companies utilize similar offshore structures and experience zero friction?
Right, they just get a total free pass.
Yeah.
Well, the central finding we will be exploring is that the market's punishment mechanism is not triggered merely by the fact that a company utilizes a tax haven.
Wait, really? It's not just the fact that they use one?
No, not at all. The penalty is almost entirely dependent on the specific coordinates of that tax haven.
Wow, okay.
Yeah, the international financial system is this heavily layered web, right? And to the people pricing corporate risk, location communicates intent.
I see.
This research provides a really rigorous quantitative look into how elite stakeholders, the ones actually driving global market sentiment, how they fill in the blanks when corporate transparency is basically non-existent.
Okay, let's unpack this. Because before we start naming specific jurisdictions and breaking down the numerical penalties, I feel like we should look at the fundamental way people assess corporate behavior when the truth is obscured.
That's a great place to start.
Because for a long time, the prevailing wisdom in academic research regarding tax havens and reputation was largely inconclusive, right?
Yeah, exactly. I mean, previous empirical studies looked at the broad data, and they really struggled to find a statistically significant relationship between tax haven use and corporate reputation.
They just couldn't find the link.
Right? Some literature even suggested that stakeholders just didn't care about offshore structuring at all.
Which seems hard to believe.
It does. But those earlier models suffered from a really significant methodological flaw. They basically treated all tax havens as homogeneous.
Ah, I see.
Yeah, they categorized every single low-tax jurisdiction into one undifferentiated group.
They were assuming that the market viewed a subsidiary in Switzerland through the exact same lens as a subsidiary in, say, the British Virgin Islands, which totally collapses under basic logical scrutiny.
Exactly. Treating all offshore financial centers as interchangeable completely ignores the vast economic differences between those regions.
Right. So to correct this, the researchers of our 2026 paper utilize something called attribution theory.
Yes.
The core premise here is that when stakeholders, whether they're rival executives or institutional investors or financial journalists, when they're faced with an informational void, they do not just throw their hands up.
No, they don't just ignore it.
They act as what psychologists call an intuitive lawyer.
The intuitive lawyer framework is so essential here. I mean, financial secrecy is the defining product of a tax haven.
Right, that's the whole point of going there.
Exactly. Because stakeholders cannot access the underlying strategic motives of the corporation, They are forced to rely on circumstantial evidence.
They have to play detective.
They do. They scan the environment for plausible causal inferences.
Hmm.
So the intuitive lawyer is essentially looking at a subsidiary's location and asking, you know, are there legitimate operation or reasons for this company to be structured here?
Or does the environment only support illegitimate motives?
Exactly.
Think of it in terms of physical infrastructure. Like if you see a logistics company renting a massive 100,000 square foot warehouse in a major shipping hub, your brain naturally infers a legitimate operational motive.
Right, they're moving goods.
Yeah, they're moving goods. That is a good reason or a legitimate causal inference. But if that same logistics company claims its primary distribution center is a P.O. box located in a vacant lot in a jurisdiction with zero physical roads.
Then your brain immediately flags a discrepancy.
Exactly. The environment just does not support the stated business narrative. That creates a bad reason or an illegitimate causal inference. And the court of public opinion does the exact same thing with corporate subsidiaries.
That's a perfect analogy. The intuitive lawyer is aggressively seeking out those location-specific cues. Because, let's be real, the corporation will never explicitly state in its annual report that a subsidiary exists solely to aggressively dodge taxes or obscure funds.
Obviously not. The PR department wouldn't allow that.
Right. So the stakeholder must infer the motive. If you put yourself in the shoes of that intuitive lawyer, the primary question becomes, what external factors actually constitute a legitimate good reason for a corporation to establish a presence in a low-tax jurisdiction?
And according to the study's data, the most powerful variable that provides that good reason is sheer market size.
Market size is everything here.
This is where the researchers finally dismantled that homogeneous approach to tax havens. They split the jurisdictions into two distinct categories. First, we have large tax havens, which includes places like Ireland, Hong Kong, Singapore, and Switzerland.
Big players.
Yeah, the big ones. And then we have the contrasting category, labeled small tax havens. These are the tiny geographical blips jurisdictions like Guernsey, Jersey, and Anguilla.
And the methodology behind this categorization was applied to an incredibly robust data set.
Yeah, this wasn't just a small sample.
No, the researchers tracked 559 multinational enterprises drawn from the Fortune Global 1000 and Fortune 500 lists.
That's huge.
Yeah, and they analyzed data spanning from 2010 to 2023, covering 14 broad industry sectors. For their dependent variable, which is corporate reputation, they relied on Fortune's World's Most Admired Companies survey.
Also known as the WMAC index.
Right.
And the choice of the WMAC survey is a critical detail for you to keep in mind here. We are not talking about consumer brand sentiment or like Twitter polling.
No, this is highly specialized data.
The respondents for the Fortune survey are top executives, corporate directors, and senior financial analysts. They are grading peer companies on highly specific metrics, things like quality of management, financial soundness, long-term investment value, and use of corporate assets.
These respondents represent the smart money.
The insiders.
Exactly. They're sophisticated insiders who intimately understand global tax structuring. When a company's score drops on the WMAC index, it reflects a structural downgrade in how the broader market perceives its risk profile and governance quality.
Okay, but here's where it gets really interesting. Because wait, isn't tax avoidance the same regardless of where it happens?
You would think so, financially speaking.
Right. Whether a multinational routes $1 billion of profit through a subsidiary in Dublin or one in Bermuda, the balance sheet impact, the amount of tax legally avoided, is often identical.
The math is the same.
So why does a panel of sophisticated executives give the MNE in Ireland a free pass, but actively punish them for setting up shop in Guernsey?
What's fascinating here is that the distinction lies in the availability of alternative narratives.
Okay, what do you mean by that?
Well, it ties directly back to our intuitive lawyer. Large tax havens, such as Ireland or Singapore, they possess highly developed consumer markets, robust physical infrastructure, and educated labor forces.
So they look like normal places to do business.
Exactly. When the intuitive lawyer analyzes a corporate structure and sees a tech giant opening a subsidiary in Dublin, a legitimate causal inference is instantly available.
They can just assume it's for regular business?
Right. The immediate assumption is market-seeking behavior. They assume the subsidiary is there to facilitate sales into the European market, hire local software engineers, or establish a regional headquarters.
So the legitimate operational reason acts as a reputational alibi.
A perfect alibi. The illegitimate reason, the aggressive tax avoidance, is heavily obscured by the very plausible very visible operational logic.
It's the warehouse in the major shipping hub. The physical market provides the cover story,
The physical market is the cover story. Now, apply that exact same analytical process to a tiny, sparsely populated tax haven like Anguilla.
where there's basically no local market.
Right, the legitimate operational reasons evaporate. A sophisticated financial analyst knows with absolute certainty that a Fortune 500 tech giant is not establishing a subsidiary in Anguilla to tap into a booming local consumer base.
Or to recruit thousands of engineers, right?
Exactly. The population and infrastructure simply do not support that narrative.
The environment completely fails to support the alibi.
It falls apart entirely. And when the alibi collapses, the bad reasons, the illegitimate causal inferences like aggressive tax evasion or the sheltering of questionable funds, they become the only logical explanation left for the stakeholder.
Because there's literally no other reason to be there.
Right. And the study's empirical findings demonstrate this penalty clearly. The researchers isolated the data and found that an increase of 10 tax haven subsidiaries reduces a company's reputation score on the 10-point WMAC scale by 0.044.
Wow. Now, a drop of 0.044 on a 10-point scale might initially sound like a rounding error to someone listening.
It sounds small at first glance.
But in the context of the Fortune Index, that fraction of a point translates to significant real-world friction.
Oh, absolutely.
I mean, it can mean the difference between maintaining a spot on the most admired list and falling off the radar entirely.
Yeah.
When institutional investors see that reputational decline, it triggers actual consequences.
It is the bottom line.
Yeah, it can lead to the risk committees demanding higher premiums on corporate debt, increased scrutiny from regulatory bodies during mergers and acquisitions, or ESG funds quietly divesting.
Exactly.
You are bleeding institutional trust and increasing your cost of capital simply through geographic association.
And that 0.044 penalty represents just the baseline friction for utilizing generic tax havens.
The baseline.
Yeah, it's just the cost of operating in an environment that lacks a market size alibi. However, the researchers discovered that the lack of market size is only the first dimension of the reputational threat.
Because the geographic penalty scales up significantly when the jurisdiction isn't just small, but actively notorious.
Right, when they have a history.
The researchers introduced a variable called country reputation for tax avoidance, or C4T, and they found that certain locations, such as the Cayman Islands and the British Virgin Islands, carry this incredibly toxic aura that alters how the market evaluates a company.
A really heavy stigma.
So what does this all mean? Think of it like having a known getaway driver on your payroll.
Oh, that's a good way to put it.
It doesn't matter what your company claims they're doing with that driver, the association alone screams guilty. How does this shift the math for our intuitive lawyer?
Well, to accurately measure the infamy of these jurisdictions, the researchers utilized two distinct methodologies. First, they mapped the locations against the Corporate Tax Haven Index.
Which does what exactly?
It quantitatively ranks jurisdictions based on their complicity in helping multinational corporations underpay corporate income tax.
Okay, got it.
And second, they undertook a massive media analysis. They used the LexisNexis database to scan 14 years of global media coverage.
14 years, wow.
Yeah, calculating the specific ratio of negatives, tax avoidance-related news coverage to total media coverage for each country.
So by parsing a decade and a half of global news, they effectively quantified the bad PR aura of each jurisdiction.
Exactly. They created a mathematical metric proving that the Cayman Islands carries heavier reputational baggage than a less notorious offshore center.
And for a multinational company, the implication there is severe. It's akin to structuring your corporate hierarchy with a known federally indicted shell company.
The PR department can issue press releases claiming the subsidiary is just for standard intellectual property management, but the geographic association overrides the corporate messaging.
Because everyone knows what that location is really used for.
Right, and in cognitive psychology, this phenomenon is explained through the concept of diagnosticity.
Diagnosticity.
Yeah, or salience. Diagnosticity refers to how strongly a specific piece of information signals a particular underlying trait or behavior.
Okay, that makes sense.
When an environment possesses a highly adverse reputation, built up over years of negative media coverage and regulatory warnings, the bad reasons for being there become incredibly salient. They achieve this hypercredibility in the mind of the stakeholder.
The association is so dominant that it drowns out any other potential explanation.
Exactly. The diagnostic value of a location like the British Virgin Islands is so overwhelming that even if a company possessed a theoretically legitimate operational reason for being there, the intuitive lawyer intuitively dismisses it.
The stigma of the location essentially neutralizes any potential alibi.
It does. And the empirical data on this is striking. The researchers found that establishing subsidiaries in the top 1 Sierra Forte locations, the absolute most infamous tax havens in the world, results in a corporate reputation reduction of 0.116.
Wow, that 0.116 drop is nearly triple the reputational damage compared to the 0.044 baseline penalty for generic small tax havens.
It's a massive jump.
It really shows that the market's informal enforcement mechanism is highly calibrated. Institutional investors aren't just docking points because a subsidiary lacks operational logic.
No, they are actively scaling their punishment based on the historical infamy of the jurisdiction.
Right. So we have established how market size and historical notoriety dictate the reputational penalty of tax avoidance. But, as corporate analysts are well aware, offshore financial centers obscure far more than just corporate tax strategies.
They absolutely do.
The financial secrecy inherent in these jurisdictions is also utilized to hide bribery, systemic fraud, and illicit political donations.
Which introduces the final and arguably most complex dimension of the study.
Yeah, the researchers designed a test to see what happens when a company utilizes tax havens while simultaneously operating in highly corrupt nations.
They cross-referenced the multinational enterprise's operational footprints with Transparency International's Corruption Perception Index.
Right, which is
Wow.
a widely used metric that ranks countries globally based on perceived levels of public sector corruption.
And the initial finding from this cross-referencing process is actually pretty counterintuitive, requires careful analysis.
Very counterintuitive.
The study found that operating in a highly corrupt nation as a standalone variable did not negatively impact a company's reputation score among the Fortune respondents.
I am genuinely struggling to see why the market draws a line there. I mean, how is it possible that doing business in a notoriously corrupt country doesn't automatically tank your reputation with these top executives?
Surprising, right?
Yeah. If a Fortune 500 company is actively generating revenue in a jurisdiction notorious for public sector bribery and institutional graft, why wouldn't elite market analysts immediately price that operational risk into the company's reputation score?
Why doesn't the mere presence in a corrupt market trigger a downgrade?
Exactly.
Well, it comes back to the search for legitimate causal inferences. A sophisticated analyst evaluating a multinational's footprint understands the messy realities of global supply chains and resource distribution.
So they give them a pass because business is messy. Sort of. Many nations with high scores on the Corruption Perception Index are also exceptionally rich in critical natural resources.
Right.
We're talking copper, lithium, crude oil, rare earth minerals.
Ah, I see. The geography is dictated by the geology.
Exactly. If you are a global mining conglomerate, your operational footprint is bound to the location of the ore deposits. You cannot simply decide to mine lithium in a jurisdiction with pristine governance if the lithium physically resides in a region with severe public sector corruption.
The market understands that gritty, complex reality.
They do. Operating in a high corruption environment often signals resource extraction or emerging market expansion, and both of those are viewed as legitimate, albeit difficult, business motives.
Right.
The intuitive lawyer evaluates the operational footprint and concludes that the company is present for the natural resources, not because they have a strategic preference for bribery.
So that legitimate causal inference is robust enough to shield the corporate reputation from the baseline corruption of the host country. Yes, the market grants them a structural benefit of the doubt. The operational necessity explains the geographic presence.
But the researchers discovered a specific tipping point where that benefit of the doubt is instantly revoked, right?
They did. The critical shift occurs when you combine those variables. The data revealed that if an M&E is operating heavily in a corrupt country, and D concurrently holds subsidiaries in a small tax haven, their reputation suffers a sharp decline.
Really? How sharp?
Specifically, a 0.05 drop per 10 subsidiaries.
Wow. But why does the addition of a distant island subsidiary suddenly cause the market to turn on them? I mean,
Right.
why wouldn't analysts just assume the shell company is being used for standard corporate structuring,
Yeah.
which international mining and energy conglomerates do constantly anyway?
Because the tax haven functions as a corruption multiplier in the analytical model of the intuitive lawyer. It completely dismantles the benefit of the doubt granted for resource extraction. Think about it. Extracting copper in a difficult regulatory environment does not inherently require a high-secrecy shell company in Anguilla.
Right, those two things aren't related.
However, if a corporation is engaging in illicit payments to secure those mining rights, and they require a mechanism to launder the proceeds or obscure the bribery,
Then the dot tax haven is the exact financial architecture required to execute that strategy.
exactly. The narrative inside the analyst's head shifts from a story of complex operational logistics to a story of international money laundering.
That makes total sense. In practical terms, this is where algorithmic trading flags and ESG compliance screens get triggered, right?
Absolutely.
When an institutional investor's compliance software detects major operations in a high corruption index country paired simultaneously with capital flows through an ultra-high secrecy offshore center, it generates massive internal red flags.
The combination leaves almost zero room for an innocent explanation. The availability of illegitimate causal inferences skyrockets.
The sophisticated stakeholders, the executives taking the fortune survey, they see the combination of a high corruption operational base and a high secrecy financial hub, and they put the pieces together.
They do the math. They price the assumption of illicit activity directly into the company's reputation score.
Right. So let's synthesize how these mechanisms fundamentally alter how you, the listener, should read global business news and evaluate corporate architecture.
It really changes your perspective.
It does. The key takeaway is that the inherent risks of offshore structuring are entirely dependent on the specific location on the map. The elite stakeholders judging these corporations are not blind, but they are highly reliant on circumstantial evidence to fill informational voids.
They use geographic presence as the ultimate proxy for corporate intent.
Exactly. When a multinational routes its capital through a large tax haven like Ireland, the market infers aggressive but legitimate global sales strategies. The benefit of the doubt is maintained.
They get the pass.
But if a corporation utilizes a tiny dot tax haven lacking operational logic, or a notoriously infamous jurisdiction with high diagnosticity, or if they pair offshore secrecy with operations in highly corrupt environments, the benefit of the doubt is systematically revoked.
Institutional trust bleeds.
And the reputational penalty translates into real financial friction.
This research really offers a profound look into the cognitive frameworks that govern the financial markets. But, as we step back and view the broader architecture of global finance, this dynamic leaves you with the final, lingering question to ponder on your own.
Oh, I'm curious.
The data clearly demonstrates that this informal social regulation, the threat of reputational damage from market stakeholders, only penalizes companies when their offshore structuring is geographically obvious or exceptionally aggressive.
Right. It punishes the use of tiny dot tax havens and notoriously corrupt networks.
Exactly. But what about the massive large tax havens? These are the jurisdictions where the overwhelming majority of global corporate wealth is actually shielded from taxation.
That's a great point.
If the market continuously grants companies a free pass in those jurisdictions simply because they can hide behind the alibi of market size, does that mean the massive large tax havens are basically bulletproof from public accountability?
That is a disturbing thought.
And if so, are our social mechanisms for policing global corporate behavior actually functioning, or are they fundamentally broken?
Wow. If the informal regulatory system only penalizes the blatantly obvious offshore structures while ignoring the jurisdictions shielding the vast majority of corporate wealth, we may be relying on an enforcement mechanism that is far less sophisticated than it appears.
It's definitely something to think about next time you see the news.
Absolutely. Thank you for joining us on this exploration of the invisible rules governing corporate reputation. Keep analyzing the geographic footprints of the companies around you, keep questioning the structural narratives you are presented with, and we will see you on the next deep dive.